In this lecture, we will begin the study of Chapter 3. Up to this point, we have studied the financial statements, the big picture of the financial statements. So in Chapter 3, now we're going to go back to look at, well, what happens before the financial statements? So we're really going to look at transactions. So we can see the definition of accounting focuses on certain events. These events have economic impact, and these events are called transactions. So for us, in this lecture, and really throughout the rest of the course, we're really going to be focusing on transaction analysis, or that'll be a big component of it. So transactions involve a give and take exchange, where something is both given up and received. And so we're going to try to identify what did we give up, what was received, and then identify that in terms of the balance sheet accounts, assets equal liabilities and stockholders' equity. And when we do that, we also want to recognize there are the two subcomponents of stockholders' equity. Common stock, which is the initial investment by the shareholders, right? They give us cash or give the company cash, and the company issues stock, and then retained earnings. Now you may wonder, well, what if we have a transaction that has income statement transactions? So let's look ahead and see, well, how is that going to fit into this horizontal model? So here's a draft of the income statement. We will be filling it out, but we know that revenues have a positive impact on that, and we subtract expenses to arrive at net income. And then that net income flows into retained earnings. So net income causes retained earnings to go up. So what that tells us then is that via net income or through net income, revenue has a positive impact on retained earnings, whereas expenses have a negative impact on retained earnings. The other thing we know that has an impact on retained earnings is dividends. Dividends are a distribution of earnings, or a distribution of net income. So dividends also have a negative impact on retained earnings. And then, of course, we arrive at the ending balance, which goes forward to the balance sheet, right? And we take that ending balance forward and put it onto the balance sheet. So it's this account right here, retained earnings, that has three items that have an impact on it. So let's go back to our big picture horizontal mode, and we can see then for retained earnings, revenue has an impact, expenses have an impact, and likewise dividends have an impact. Dividends there. So revenues, expenses, and dividends. Okay, so that's how we will analyze those in terms of what I will refer to this now as the horizontal model. Okay, you also need to have out of Chapter 3, Problem 1B open. So you might just pause this video right now and turn to Problem 1B out of your textbook or go to Wiley Plus and find it. And then we will start the analysis. Okay, so let's turn our page. We're going to use Problem 1B, and we're going to go step by step, identify what was received by the company and what was given up. So Problem 1B, the company's name is Hyman Inc. They were started in May, and this is going to be for the month of May for this particular company. Transaction 1 tells us stockholders invested cash of $30,000 cash in the company in exchange for common stock. So what was received? Well, $30,000 cash was received. And what did the company give up? And again, we're thinking from the company's perspective. The company gave up common stock. Now we want to go back and think then in terms, are each of these, are those, these items assets? Are they liabilities? Are they stockholders' equity? And if they're stockholders' equity, is it common stock or retained earnings? Well, obviously common stock is common stock. And again, so that's going to be, a part of stockholders' equity. And we're issuing stock. So the number of shares outside the company is growing. So common stock is growing, it's getting bigger because we have more shares out there. Cash, as we all know by now, is an asset. And if we're receiving cash, it's going up. So we can see then, we're going to keep this horizontal model in balance. There's $30,000 of cash that came in. That's going to cause assets to go up by $30,000. We issued $30,000 worth of common stock shares, right? Those are just stock certificates with a dollar amount on them. So the number of shares and the dollar amount of shares outstanding went up. Okay, so we're going to go to our horizontal model, the grid, on the next page or two in your notes. And we're going to record assets going up and stockholders' equity going up. Okay, so this is the first month. So we can see I put beginning balances in a 0. Notice that I have the company's name. We have the assets, liabilities, stockholders' equity. I went ahead and listed all of the types of assets we're going to encounter in this problem. There's only going to be one liability. We'll have common stock. Again, retained earnings. Remember the 3 subcomponents of that. So number 1, we want to show the cash coming in of $30,000. So you want to put $30,000 here. That's going to equal the $30,000 in common stock. So we keep this equation in balance. Assets go up with cash, and then the other side goes up with $30,000 in common stock. Okay, let's go to transaction 2. In transaction 2, the company purchased equipment for $10,000 cash. So then I have to identify, what did the company receive? What did it give up? Well, the company received equipment. I'm just going to abbreviate that. And what did it give up? Well, it bought equipment in exchange for cash, so it gave up cash. So what it received is equipment, what it gave up is cash. Now we go and identify what element, are these items. Equipment is a resource, so it's an asset. Cash is also a resource, and it's an asset. Now let's identify, are these going up or down? Well, equipment came into the company, so it's going to increase, right? It's increasing our assets. Cash, on the other hand, we gave up, so cash is going down. So we're going to see for transaction 2 that equipment is going to cause assets to go up by $10,000, and the cash spent will cause assets to go down by $10,000. And that's going to keep the accounting equation in balance. It's an asset exchange. Equipment went up, causing assets to go up. Cash went down, causing assets to go down. Let's put it in the horizontal model. So we're going to see then, we're going to show the decrease in cash and the increase in equipment. Those cancel each other out on the asset side, so there doesn't need to be anything on the other side. Okay, transaction 3. On transaction 3, the company paid cash for office rent for the month of May. So the company paid cash, so that's what they gave up. So the company gave up cash. And what did they get in exchange? What did they receive? Well, they got to use the office. So they got to use, they received rent, I guess is one way of saying that. So they got to use the office itself. So they got to use the rent. So now let's go through and identify these. Cash is an asset. And we know we gave it up, so it's going down. Let me kind of do a break here so we can see the difference. So, okay, so the company gave up cash. That's an asset, and it's going down. Now, what is rent? So let's think about that a little bit. Let me erase this off of here. In accounting, we have costs. And there are 2 optional ways of recording costs in accounting. Costs can either be recorded as an asset or they can be recorded as an expense. Assets haven't been consumed yet. So there are costs that we haven't used or consumed yet. So it's not consumed. Whereas expenses have been used or have been consumed, or they have been used, whichever word you prefer. So we have used that cost. So costs can either be an asset or an expense. With the equipment back in number 2, we haven't fully used the equipment, so it was an asset. But the rent here in May, we paid cash for rent for the month of May. So that cost has been used, right? We used the office facilities for the whole month of May. So that is going to be an expense. Okay, and let's recall, revenues cause retained earnings to go up, expenses cause it to go down, likewise dividends cause it to go down. So if we have an expense, that's a component of retained earnings, and it's causing retained earnings to go down. So cash will cause assets to go down, rent expense will cause retained earnings to go down, and I believe this was for $700. So we'll go put this on a horizontal model for transaction 3. Okay, so in this one, we've got cash going out, and then we also have an expense causing retained earnings to go down. So under retained earnings, we have an expense, and then so when we go to write out our income statement, let's also write a description of what that expense. So it was for rent. So we have cash going out for an expense, which is rent expense. And let's put our equal sign in there as well. Okay, let's go on to the next transaction. For number 4, the narrative reads, the company purchased $750 of advertising in the Evening Times on account. So what did the company receive? The company received advertising. And what did they give up? Well, if you say cash, you're wrong. That's usually the first thought is they had to pay for it. But they didn't pay for it. They bought it on account. So they purchased advertising on account. That means they owe money. So which is really a promise to pay later. So they're promising to pay later. They owe money. So we're going to call that account payable. It's a payable, and they'll have an account with this advertising, with the Evening Times paper. So they owe money, so they have a payable. They have a payable, so they have an account with the newspaper. So they have an account payable with the newspaper. How do these fit into the balance sheet? Well, if you owe money, that's a liability. And that liability is going up by $750. So over here we have a liability growing, and the liability account is accounts payable. Advertising, it's a cost. Is it an expense or is it an asset? Well, we're going to have to assume, this problem wasn't overly clear, but we will assume the advertising ran during the month of May. If the advertising ran in the paper during the month of May, then it's a cost that has been consumed or used, and making it advertising expense. So expenses are a component of retained earnings, causing retained earnings to go down, $750. So again, we're going to assume the advertising ran during the month of May. It's been used, so it's advertising expense. Advertising expense is a component of retained earnings. It's a negative component, so retained earnings will go down $750. Liabilities will go up. They will counterbalance each other when we get to the horizontal model. Let's go take a peek. And I see I jumped ahead. This actually is transaction 5, not number 4, so my mistake, but let's just go ahead. We know that there will be a $750 expense causing retained earnings to go down, and we want to describe that as advertising. The other thing is that we've got a liability growing, $750. So that's going to keep the equation in balance. So on this side, we have a positive 750 and a negative 750, and it balances out. Okay, let's go back and do transaction 4.